breakdown. Let's bring in the chief equity strategist at Stifel, Barry Bannister. Barry, great to see you. Thanks so much for joining us. So just break down your base case first of all. It's for some kind of correction. To what extent? 10% or so in the S&P, and how soon?
First off, it's nice to see you back. And yeah, our view actually is a correction first. The S&P through the end of the third quarter, it's many of the things that Bob Pisani outlined, and he does a great job on that. The deceleration of the earnings growth, the very high PE ratio, the stickiness of inflation, and we actually think there's a mild case of stagflation building into the third, early fourth quarter. You've got some weak economic data, and you've got sticky inflation. So it does put the Fed in a bind, and stocks are expensive versus financial conditions index, for example, particularly the cap-weighted S&P, which looks like it has about 3.5 PE multiple points on forward earnings of AI-related froth relative to the more fairly valued equal-weighted index.
So if we're talking about the possibility of stagflation, why are we only talking about a small correction? I mean, surely that takes us, with stocks prices they are, into a scenario where we should be seeing a massive pullback.
4750 is a pretty massive pullback. It's in line with those that you saw when there was uncertainty related to the Fed in the mid-2010s, 2015, 2016 timeframe. The dollar was too strong. The industrial side, as you saw from today's Purchasing Manager Index, was weak. The inflation this time is the new wrinkle. We think it'll pop back up on the core PCE inflation to the mid-20s on a month-over-month basis in basis points. That would probably print 3% on core PCE by the end of the year. We watch all the elements of it, supercore, housing contribution, and so forth. So when we're looking at that and the likelihood that productivity, which has bounced back after the, call it a pseudo-recession of 22-23, there was a recession in everything but employment, that the productivity bounce back looks like it's spent. It will roll over into the back half, and you'll have rising unit labor costs. So there are a number of things that I would be concerned about in this calendar seasonally weak period through the late summer, early fall.
Stifel also has a piece out about Bitcoin and the signals that it sees suggesting an imminent S&P 500 correction warning. What are those signals that you see, and why does it have a barometer on what the S&P does?
Yeah, that was me. The Bitcoin piece is interesting because when you look at it, it's not any sort of thing like that. If you look at every major up move in Bitcoin for the last dozen years since 2011, it occurred right when the Fed pivoted to dovishness. So Bernanke announcing QE3 in September of 2012, Chair Yellen pivoting in the first quarter of 16, all the Powell pivots that we've seen in his tenure, and there have been several. Every time they pivot, Bitcoin takes off. It's a cheap money, easy liquidity play, a hypercharged play on that. And every time Bitcoin peaks after those major moves up, mathematically, it leads to a weaker or flat S&P. And the S&P right now is at the very top of the trading range we expect related to Bitcoin. I think it pulls back easily 5% into the July-August timeframe. But we're looking for a little bit more on the S&P pullback.